Welcome to this explainer. Today, we're diving right into the incredibly mixed signals of the April 2026 economy using the latest Retail Monitor report. We're going to unpack the hidden pressures that are absolutely reshaping the retail landscape. We'll break down the current consumer mindset and see exactly which retailers are thriving and, well, which ones are barely surviving. Let's start by acknowledging a massive paradox in the market right now. If you look at the raw data, we're still spending to the tune of over $390 billion a month. On the surface, that looks like a super healthy economy, right? But dig a little deeper and you'll see that inflation and those lingering 2025 tariffs are creating massive disparities. A huge chunk of that spending volume is actually being driven by elevated prices, not an increase in the actual volume of goods being bought. And that brings us to the very real, day-to-day pressure on the everyday shopper. With unemployment hovering above 4% and utility bills absolutely surging, interestingly enough, thanks in part to the massive electricity demands of AI data centers, shoppers are really feeling the pinch. I mean, they're fundamentally changing how they buy. They're slashing discretionary spending and relying way more heavily on credit cards literally just to get by.
So let's jump into Section 1, the K-shaped consumer economy, or a tale of two shoppers.
This dynamic paints a really fascinating picture. On the upward arm of the K, affluent shoppers are continuing to spend freely on luxury. They're practically insulated from daily economic pressures. But on the downward arm, middle and lower income households are heavily cutting back just to afford daily necessities, like fuel and groceries. What's truly alarming in the data is that these consumers are increasingly relying on buy now, pay later services. And we're not talking about buying luxury sneakers here. We're talking about using them for basic, everyday, essential purchases.
This uneven pressure cooker has triggered a massive wave of retail bankruptcies in 2026, completely upending legacy brands. Just since the start of the year, we've seen filings from Saks Global and Neiman Marcus on the luxury side, all the way down to mall staples like Francesca's and Eddie Bauer. It's a brutal reality. If a brand fails to capture a distinct segment of this heavily divided market, they are simply squeezed out.
Moving right along to Section 2, the rise of the AI shopper, and how algorithms are basically taking over the aisles. Now, technology is aggressively responding to these exact consumer constraints. We are rapidly, and I mean rapidly, entering the era of agentic commerce. This isn't just about a website recommending a pair of socks anymore. Brands are completely restructuring their platforms so that an AI assistant can independently hunt for discounts, wait for a price drop, and seamlessly execute a purchase on your behalf. It is an absolute game changer.
So how are retailers actually pulling this off? Well, from chatbots offering styling tips to fully automated purchasing agents, companies are leveraging these tools to squeeze out every ounce of operational efficiency. They're using AI to optimize pricing in real time, accurately predict inventory, and, this is key, capture sales from hesitant buyers by offering hyper-personalized deals exactly when that consumer is most likely to click buy.
Because of all this, ensuring your e-commerce platform is agent-friendly is no longer just a nice-to-have, it's an absolute necessity for survival. Think about it for a second. If a retailer's website security accidentally blocks an AI agent from shopping for a customer, that retailer is going to lose the sale entirely. We are quite literally witnessing a fascinating technological arms race. All right, let's pivot to Section 3, GLP-1s reshape the wardrobe. This is all about the completely unexpected ripple effect of weight loss drugs.
You know, you'd probably think widespread weight loss would trigger a massive apparel buying spree, right? But check out this recent statement from big and tall retailer DXL. It highlights a fascinating paradox. Sales are actually taking a temporary hit. Why? Because consumers are deliberately holding off on purchases. They're essentially waiting to stabilize their weight before investing in a brand new wardrobe.
And this is causing an absolute logistical nightmare. Apparel brands are being forced to aggressively rebalance their inventory mix towards smaller sizes, practically overnight. On top of that, because consumers are suddenly unsure of their new sizes, online return rates have absolutely skyrocketed. So retailers are having to eat the shipping and restocking costs of these returns, which is severely pressuring their margins. This brings us to Section 4. Discount retailers win big, driven by this incredible rush for value.
This intense consumer focus on optimizing every single dollar, well, it's creating some very clear winners. The data shows staggering gains for brands like Five Below, up over 15%, and TJX up 5%. Meanwhile, traditional department stores that operate in that muddy middle ground, think brands like Target, are suffering steep declines. The modern consumer is incredibly protective of their wallet right now. So why exactly are they winning?
Well, these discount champions brilliantly mitigated the 2025 tariff impacts by stockpiling goods early and expanding high-margin private labels. But their absolute smartest move? Opening smaller, localized store formats. By moving right into high-density neighborhoods and heavily focusing on groceries and household essentials, they are capturing the consumer right where they live. Which takes us to our final group, Section 5, the cost of luxury, focusing on gold, silver, and Swiss watches. Swinging back to the upper arm of that K-shaped economy we talked about, we see some truly bizarre contrasts. High-end brands like Bloomingdale's and luxury watchmakers like Swatch Group are seeing massive revenue surges from those completely unaffected affluent shoppers. But traditional mall jewelers like Signet, the folks who own K-Jewelers and Zales, are actually shrinking. They've watched sales dip and even announced plans to close roughly 100 stores in 2026. And this divide is heavily driven by what's being called the precious metals squeeze. Geopolitical tensions have caused commodity prices to just absolutely skyrocket. With gold nearly doubling and silver jumping 60% at the start of 2026, everyday jewelry is becoming wildly expensive. I mean, it is literally pricing the middle-class consumer right out of the fine jewelry market, pushing younger buyers toward lab-grown diamonds just so they can afford an engagement ring.
All right, let's wrap up this explainer. As we've seen today, some wildly disparate forces are currently colliding. Everything from AI algorithms shopping on our behalf, to medical breakthroughs altering clothing sizes, to global conflicts spiking the price of silver. All of these factors are dictating exactly which retailers survive this highly volatile, K-shaped economy.
I'm going to leave you with this final provocative thought to ponder today. We've seen incredible resilience in the spending data so far, for sure. But as the cost of basic essentials, utilities, and tariffs continues to quietly drain middle-class wallets, at what point does the remarkably resilient American consumer finally break? Thank you so much for joining me for this explainer, and definitely keep an eye on these shifting retail landscapes.